Good afternoon or good morning, everyone. I'm delighted to see so many familiar names already joining us at this live webinar. We are hosting this webinar for our Insight members only, so hence you should all be familiar with Pangea-Risk. We are a specialist intelligence advisory providing country risk forecasting solutions. Over the past few weeks, we have been presenting on the Gulf War and other themes for our clients and at different conferences. And we thought it would be a worthwhile opportunity to speak directly with our Insight members as well. We have a little presentation lined up for you and we'll be open for questions and answers, which you can drop directly into the Q&A box at the bottom of the screen. We compile all our intelligence through regional expertise in the Gulf, but also in Africa and Asia. We rely on our human intelligence network and our technology-enabled platform to provide you with risk forecasting solutions on the Insight platform and, of course, also on a more bespoke advisory basis. All the information we are sharing with you today is available on the Insight platform. So at any stage after this presentation, after this webinar, feel free to reach out to us to make sure you can log in correctly to the platform. You are aware of the platform's full functionality and latest features. And if any of your colleagues should be onboarded on the platform, again, this is a right opportunity to reach out to us to make sure that you are maximizing your Insight membership with Pangea-Risk. Over the past month, the world has changed dramatically, and we have seen this reflected in fuel prices in the United States of America, in fuel shortages in key Asian markets. We have seen attacks throughout the Gulf and Middle Eastern region, and indeed a variety of challenges and potential opportunities for African markets, where again the diversification and rerouting of trade is impacting emerging markets across the world. At Pangea-Risk, we monitor all countries in the world at a quantitative rating level, but we provide qualitative risk assessments on 102 countries in Africa, Asia, and the Middle East. And that's our focus for this webinar today. Maybe the right way to start off is to ask our lead analyst on this call, Bilal Basyouni, to provide a bit of a summary of the Middle East conflict and the Gulf War situation so far. Bilal is our head of risk forecasting and our lead Middle East analyst. Bilal, thank you for joining. Could you give us tell the audience where are we at with the conflict and what is the commercial impact so far?
Thanks, Robert, and hello everyone. Thank you for joining. So, as we all been following over the past few weeks, the conflict has moved through phases, but most recently it's been transitioning into a high-intensity, multi-front war involving active Iranian strikes against US bases and civilian infrastructure, which reached now almost 9 Gulf states, and reciprocal attacks targeting Iranian civilian and military sites as well. And most recently, just over the past weekend, Yemen's Houthi movement has now officially entered the conflict, firing ballistic missiles at southern Israel and threatening to close the Bab el-Mandab Strait, which creates a potential second blockade of global shipping. So far, this has triggered the largest supply disruption in global oil history. So the de facto closure of the Strait of Hormuz and the retaliatory strikes on Gulf energy hubs like Qatar's Ras Al Khaimah and Saudi Arabia's Ras Al Noura have actually sent Brent crude prices past the $120 per barrel and forced global markets to already reprice for sustained stagflation. And beyond energy, Robert, it's important to note that the conflict has also fractured the Gulf's safe haven economic model, causing a systematic supply emergency due to an 80% distribution in regional food imports and a near cessation of regional aviation. effectively shifting the risk profile of several Middle East countries, and possibly adding more countries to those high risk profiles over the coming weeks.
Thank you very much, Bilal. I think it's time we also looked at the baseline scenario in terms of the next steps in the conflict. We've over the past few days have been assessing how Iran's proxies will react and how the world, shipping routes around the world, will be infected by the conflict. In terms of our latest analysis, which has been published exactly at the same time as we started this webinar, we have provided a new baseline scenario assessment for the conflict. Bilal, there is multiple ways to look at this. There is obvious escalation, but there's also de-escalation pathways. You've identified 2 de-escalation pathways. Can you please run our audience through those potentially slightly more optimistic scenarios for the next few weeks ahead?
Yes, of course, Robert. So as you mentioned, we've already published on this. So members are welcome to go and view these reports for more detail around these scenarios. We expand on this quite a bit. And on a positive note, we wanted to start with some of the de-escalation scenarios that we've covered. So this would likely take the form of a partial stabilization of the conflict, both these scenarios, rather than a full resolution, given the complexity and the nature of this conflict. In one pathway that we assess, transit through the Strait of Hormuz can resume under tightened conditions, given that we are seeing a stronger mediation over the past few days and talks being hosted by Pakistan, which could allow managed passage, but still will allow Iran to retain leverage over these flows. And as I mentioned, the Houthis have reactivated the forceful posture in the Red Sea. But in this scenario basis, we likely see that form of involvement remain intermittent and at low scale. So some shipping does continue under this scenario, but with elevated insurance in this stage. In another pathway, military activity can be reduced through a ceasefire arrangement, a fragile one, albeit, but without a formal settlement. So the US limits further escalation, manages to rein in Israeli attacks against Iranian infrastructure, which then lowers the intensity of the operations, but without changing the overall belligerence of the parties involved in this conflict. And Iran, in this scenario, will maintain its deterrence without sustaining any maximum disruptions at both the most important choke points that we covered here. But in both cases, Robert, costs remain structurally higher and are unlikely to return to pre-war levels in the immediate term.
Thank you, Bilal. Based just on the past 24 hours or so, it is very difficult to convince people there's any kind of de-escalation pathway at this stage. So, let's look at the less optimistic scenario, and that's potential for escalation going forward. And again, we've worked on 2 potential escalation pathways. Could you run us through the core direction and indeed also the impact that these escalation pathways could have?
Yeah. Similarly, the escalation scenarios are unlikely to shift the grounds completely from what we are seeing at the moment. Rather they entrench them or even widen their geographic and intensity scope. So one pathway would likely see a simultaneous disruption at the Hormuz and Bab el-Mandeb Straits, where Iran tightens control over passage and Houthis support that expanded scale and consistency of limiting vessel movement in those straits. So this removes both the primary route and the main alternative. And we may have been following, particularly Saudi Arabia has tried to activate its inland routes to circumvent the Strait of Hormuz, bypassing that choke point to try to use the Red Sea. But now with the Houthis back on board, that choke point also becomes a challenge to transit. So this sharply increases shipping delays and energy costs. The second and more doomsday worst case scenario pathway that we've also uncovered is a broader regional conflagration. So this will see an expansion of the conflict through sustained attacks on energy infrastructure, ports, logistics, and also other civilian assets such as desalination plants that was already entered the rhetoric of around the conflict. And this could be combined with deeper US involvement. The possibility of US troop deployments also increases in this scenario, not necessarily on Iran mainland, but even Kharg Island, which is a strategic island around the Strait of Hormuz, that could see US concentrating around taking control over that particular strategic asset. And then that could draw more direct Gulf participation in the conflict. Also, geographically, we may see an expansion in both the Iraqi and Lebanese fronts, which will likely become more active. And in essence, both these cases or both these pathways, the effect is a prolonged disruption to exports, higher global energy prices, and tightening financial conditions around the world.
Let's hope we won't reach that doomsday scenario. But thank you for laying out the various different escalation paths for us. For everyone on the call, I realize there's a lot of detail on these different slides and escalation pathways. The good news is it is in your inbox already. The inside briefing that we published at the top of the hour has all this detail included in there. Maybe before we start talking about the impact on different regions like Africa and Asia, Bilal, could you just talk us through some of the transmission pathways? In other words, how these shocks will start to impact countries around the world?
So these transmissions to global economies, Robert, is already established. But what we're likely to see is an intensification under an escalation scenario. So higher oil and gas prices are feeding directly into inflation and trade balances. But the strongest impact so far has been in South Asia and parts of Southeast Asia. And also some African fuel importers have felt the brunt of these changes already. Shipping disruptions are increasing the cost and time required to move goods, raising prices for fuel, food, and also fertilizer, which is an important ingredient for agricultural inputs. And this comes across multiple regions. The financial transmission part is more visible through a stronger US dollar, given a lot of investments are moving towards stable currencies, higher import bills, and reduced availability of trade finance, which is increasing the pressure on foreign exchange and sovereign liquidity in a number of economies. But to highlight a few here, Egypt, Kenya, Ethiopia, Pakistan, and Bangladesh are most exposed and vulnerable to these shifting conditions. But also some domestic effects can follow, particularly given the fuel and food price increases. So this raises the cost of access to goods, and the likelihood of public unrest does increase pressures on governments who already struggle with limited fiscal capacity. In a de-escalation sense, Robert, we may see the rate of deterioration slow down, but does not reverse these pressures immediately. I think the markets will take a long while to readjust, given how high risk these conditions have been so far.
You know, Bilal, just before we started this webinar, the newswires announced that President Trump will be holding a primetime television address later today. And markets are already anticipating some sort of a ceasefire or pause to the conflict. But almost disregarding that, these escalation pathways remain relevant because, to a certain extent, much of the transmission of these shocks to economies beyond the Middle East is already happening. And as you rightfully said, and just like ECB President Christine Lagarde said yesterday, much of this damage will last for months, if not longer, and will have an impact on Asia, and indeed Africa. And maybe let's start with the African continent first, because there is a short-term impact for Africa that we need to assess. There are some winners and there are some losers from this conflict. How have we been assessing this? Well, we've been using our proprietary risk forecasting methodology to look specifically at a variety of risk perils across the African continent. This includes political, security, and economic perils of risk. We use qualitative risk scores to define the rating for each country. You will find these on the Insight platform. Many of these have indeed changed recently. Some in a more optimistic outlook, like Kenya and Uganda, but others have taken a deterioration, just like some of the ratings in the Gulf. And that's because the short-term impact on African markets is quite varied. In fact, the immediate impact is based on commodities. It is based on gold, oil, and fertilizers. It's an easy way to categorize the immediate impact. In terms of gold, it's all about supply chain. Supply chain in terms of flying gold and diamonds from the African continent to the big hubs in the Gulf region. Or indeed, the supply chain and logistics network that crisscrosses the African continent, interconnecting mostly Emirati-operated ports around the coastline of Africa, again interconnecting to the Gulf region. The supply chain disruption was immediate a month ago, and the lasting effect will be certainly felt in many of these markets for the remainder of this year. It is also certainly about oil prices, but more specifically, it's not about the oil price, it's about the fuel price. And this again means that landlocked African countries are bearing the brunt. Countries like Zimbabwe, Malawi are already seeing the highest fuel prices with an immediate knock-on effect on their local economies. It also means that many fiscally vulnerable countries like Senegal and Sierra Leone, which have been flirting with debt restructuring or indeed sovereign default over the past year, and even countries like Botswana, which have seen an economic recession of late, are all exceptionally vulnerable. I'm joining you from South Africa, where at midnight tonight, petrol and diesel prices will go up significantly. A lot of panic buying in many of these African countries, which again could stoke political and indeed a civil unrest in the coming weeks. Let's take a look maybe a bit more at the currency outlook for many of these African countries. And we're joined by Jack Brodsky, our country risk analyst. Jack, thank you so much for joining us. You've recently looked at the impact of the Gulf War oil prices on African currencies. Can you share some of your findings with us?
Thank you, Robert. Yes, as you've mentioned, over the past month, we've seen how second-order economic effects from the Gulf War have already exerted cascading economic strain in African markets, and notably global supply chain disruption and damaged investor confidence are threatening to reverse positive currency trends that we saw in 2025. Between January and December of last year, the US dollar index dropped by approximately 6.5%, with the Ghanaian cedi, the Congolese franc, the Zambian kwacha, and the South African rand all performing strongly against the greenback. Notably, the cedi strengthened by more than 40%, the first rise in over 30 years, and the kwacha and the franc rose by over 20%. And while we saw some small rallies this morning, perhaps an indication of the press conference that Donald Trump is hosting that you mentioned, the dollar has outshone traditional peer safe haven assets, including gold and the Swiss franc, since the conflict began. And data shows that the dollar index has risen nearly 3% since March. And any prolonged conflict or extension to global disruption elevates the risk of currency devaluations, especially in import-dependent countries that face higher oil prices, transportation costs, and considerable external financing needs over the coming year. This is all taking place within the context of extremely high debt repayments that are scheduled for the coming year, with African sovereigns facing the debt wall of approximately 90 billion US dollars. And any sort of further currency devaluations would make these repayments much more expensive, straining public finances and tightening fiscal space in the next few months.
Indeed. Bit of a sad story, because many of these African sovereigns were looking at a year of recovery on the back of a fiscal recovery, potentially tapping into international debt markets. So certainly a sad awakening and a test of resilience also for many African countries. Again, it's not just about the immediate impact, it's also about longer term impact. And that's where fertilizers come in. Fertilizers are essential for the food security of African countries, and indeed also for many of the cash crops like horticultural and agricultural products from key markets like cocoa, or indeed tea and coffee and flowers from the East African markets. The biggest buyers of fertilizers are Ethiopia, Kenya, Ivory Coast, Nigeria, and Zambia, to a lesser extent South Africa. And much of that fertilizers and phosphates is coming from Saudi Arabia and Qatar. With many other fertilizer supply chains distressed around the world, the pressure is rising on Russia, China, Germany, and other producers of fertilizers to send their share or Africa's share of fertilizers to African farmers. It's potentially an opportunity for fertilizer exporters like Morocco, Tunisia, and others. At the beginning of the Russian invasion of Ukraine, we saw Morocco turn fertilizers into diplomacy, offering low-cost access to fertilizers in exchange for political or diplomatic concessions. That certainly could be an opportunity and an interesting play in the longer term, but we have to bear in mind that this will impact African food security, which is very much intertwined with Middle Eastern food security as well. We're going to look at a couple of African countries specifically impacted by the Gulf War. If you have any questions or would like to talk about a specific country, then just drop your question into the Q&A box at the bottom of the screen, and we will pick up that question. In the meantime, I just want to run through Nigeria, because of course this is a country which just 2 years ago was going through an economic and fiscal crisis, and since then has gone through a raft of economic and structural reforms which have built up the resilience of the Nigerian economy. And that's also because of the launch of the Dangote refinery. Angola is now benefiting from its oil exports at increased output and increased pricing, but it's also benefiting from exporting refined product. Indeed, the Dangote refinery is essentially operating at full capacity, which means it is supplying 100% of Nigerian domestic demand and can export to countries like Ghana, Tanzania, and others. Fuel prices, however, have gone up over the past month in Nigeria, and this will have an inflationary impact. In terms of the gasoline prices, as you can see on this chart, the prices already started to go up last month, and that's when Nigeria cut off fuel import licenses, essentially ensuring that Dangote is the sole importer provider of refined product. This makes the inflationary outlook particularly vulnerable. So far, the Central Bank of Nigeria has essentially decided to hold interest rates still. But the CBN and the federal government is preparing for a Naira defense strategy. Food insecurity, fiscal shocks can certainly lead to inflationary trends and a knock-on effect on the Naira currency. And in that case, we're likely to see rising interest rates in the coming months and quarters. That's, as I mentioned, Nigeria is one of those few countries in Africa which has seen debt to GDP stabilize, foreign exchange reserves recover, and it does mean that Nigeria today is more resilient than other African markets. It's probably also why we've seen far fewer capital outflows. And that puts it into a direct contrast with Egypt, and I'd like to bring Bilal Bassiouni back into the conversation here, because the contrast between Egypt and Nigeria is quite stark, Bilal. Why have we seen such an outflow of such a capital outflow in Egypt over the past few months compared to Nigeria?
Yeah, I think that's a great contrast here that you raise, Robert. So Egypt is quite different, primarily because it's a net fuel importer and with a massive high import bill. And we'll discuss particularly what the slide that we're seeing here in a second. But it's just to contextualize Egypt's conditions over the past few years. As we all know, Egypt has been going through a massive balance of payment crisis, which peaked in early 2023. However, it managed to win a lot of Gulf support, external financing, and also multilateral lending from institutions such as the IMF and World Bank. Now, this is being constrained by a renewed external shock, which is centered on shipping on energy, and the ongoing disruptions in the Red Sea has reduced or kept Suez Canal traffic at quite low volumes, which directly affects one of Egypt's main sources of hard currency. Now, what we're seeing in front of us in terms of this slide has been a lot of the GCC-led investments in the country, particularly from the United Arab Emirates, Saudi Arabia, and Qatar, which has focused into real estate, infrastructure, and coastal development projects. So these are still providing liquidity and have supported Egypt's external balances. In fact, these have bolstered Egypt's foreign exchange reserves to almost 6 months record highs that we haven't seen in a very long time for Egypt. But these inflows are now exposed to the conflict environment. If Gulf states face sustained security pressures, higher fiscal demands, or delays to export revenues, the capital allocated to Egypt to these mega projects may now slow down or even be rephased or reprioritized towards the GCC's domestic and strategic spending. At the same time, as we see in front of us here, the higher oil prices and freight costs are increasing the import bill, particularly for fuel and food imports, placing immediate pressure on that foreign exchange reserves that I spoke about earlier and on domestic pricing. And these inflows are being offset by the weaker canal revenues, as I spoke about earlier, higher external costs, and renewed inflation, following again the recent fuel price adjustments that the government just recently announced last week. So this is tightening the domestic liquidity and increasing the cost of maintaining subsidy and spending commitments that the government has done since the IMF program. If the disruption to the Red Sea shipping persists over the next 6 months, the strain will deepen through reduced dollar inflows, higher import costs, and continued price pass-through into the domestic economy, which could place the current recovery path under continuous and sustained pressure, even without a sudden stop in external financing.
Thank you. We were going to talk briefly about Kenya, but we've actually received a number of questions, and thank you very much for that. And maybe to address some of these, I wanted to talk about Angola, Malawi, and Ghana specifically. I've mentioned Malawi briefly earlier, being one of the countries that is fiscally vulnerable. And it's landlocked. Fuel prices are already at a record high. And of course, it is a country that is going through a potential domestic debt restructuring scenario on the back of the external restructurings it has already carried out. So Malawi certainly is vulnerable and is certainly a country that's on our watch list and that could see quite an impact from a protracted or indeed escalation scenario, as Bilal laid out at the beginning. For Angola, it's a bit of a mixed bag because, yes, we've already seen Angola starting to attract more and more foreign direct investment, particularly into its gas potential, and could also see a boost to its foreign exchange revenues from the oil production sector. That said, Angola desperately needs to diversify its economy. And therefore, being so heavily import dependent, this could be a potential for holding back many of the privatizations and many of the investment necessary into other parts of the economy. So we are concerned that a protracted or escalation scenario could mean that Angola would start to suffer the impact of being too import dependent that is no longer offset by the benefits of its oil windfall or its revenues. For Ghana, certainly also higher revenues from the oil and gas sector should benefit the fiscus, but Ghana has not been able to fly out many of its gold products and some of its other metals to Emirati markets. In fact, some gold producers in Africa are now looking to Riyadh and Saudi Arabia to become a new hub rather than Dubai in the Gulf. This is an interesting trend because, of course, it impacts lots of metals producers and diamond producers across the African continent. So we are a bit more cautious on Malawi, but we are more positive on Angola and Ghana in case of a de-escalation or a shorter pathway. This might then also be a good point to actually mention that we recently published a Africa debt report. Bilal, you led on this project, and we talked about all these countries here, like Malawi, like Angola, like Ghana. Can you remind us of the key findings of that Africa debt report in the context of the impact of the Gulf War?
Yes, Robert. So in that report, we argue that the war is tightening African sovereign risk through foreign exchange and financing constraints, similar to what we saw in the Egypt example, with the impact being concentrated in fuel importing externally financed economies. So these countries such as Kenya, Egypt, as I mentioned, Ethiopia, Malawi, are facing higher fuel and freight costs. At the same time, their currencies are weakened by the day, so which is compressing the fiscal space and increasing reliance on external funding, which is becoming more and more difficult to access. So governments are already responding to these challenges with more interventions in foreign exchange and pricing systems, including tighter allocations of hard currency and adjustments to fuel pricing. And this can translate into reduced access to dollars, delays in payments and repatriations, and also higher operating friction, particularly in these import-dependent sectors. Overall, the debt distress is building as refinancing is also becoming a problematic issue. And we're not likely to see any default risks become imminent at this stage, but increasingly in the longer term, the longer the conflict takes fold. But Kenya here is the clearest case where the higher borrowing cost and weaker market access are tightening liquidity and crowding out the private sector more and more. Also, Ethiopia remains dependent on external support and exposed to prolonged pressures. So this also feeds into the banking systems through weaker asset quality and tighter liquidity, and can also, for Ethiopia, blockade its current renegotiations under the common framework to restructure its debt.
Worth noting that this comparative rating slide you currently see is available for download on the Insight platform and is updated on a weekly basis. The non-payment risks are obviously key for sovereign transactions and for trade finance transactions, but there's a lot of our development finance clients on this webinar call today as well. And therefore, we need to also look at, in the broader context of tariff, imposition of tariffs, global economic slowdown, what this new Gulf War means for development finance. And this is where I'd like to bring in Jack Brodsky again, who's recently spoken on this topic. Jack, could you just share some of your findings in terms of the outlook for development finance in emerging markets?
Well, yes, Robert. We've seen over the past couple of years traditional public and grant-based funding, such as official development assistance, contracting under pressure and policy realignment, with data showing that aid flows from OECD Development Assistance Committee members declining by 6% between 2023 and 2024, with further projections coming in the coming years. And the impact of these reductions have been felt acutely in sub-Saharan Africa, with countries facing a real reduction rate of between 16 and 28%. And these pullbacks demonstrate how the architecture of global development has been really wholly rewritten. And if we take a step back from this, what has driven these pullbacks from major donor economies. So of course, several factors such as slower economic growth, elevated debt servicing costs, and a rise in domestic commitments to defense spending and social protection spending, coming together to compete with these previous overseas development commitments. And these pressures will certainly all have been exacerbated by the Gulf War. Looking ahead, we anticipate that public budgets are unlikely to return to previous levels of concessional support in the near term, with geopolitical competition and fragmentation set to deepen and rather than recede. For our full report on this, please have a look at the Insight platform for the Global Development Finance in 2026 Capital Under Constraint report.
Thank you, Jack. That's great. It's not just about the non-payment outlook and the economic impact. There is also political implications of the Gulf War, particularly in the context of many African and Asian elections that still need to happen later this year. In fact, an election in Benin will be taking place in just 2 weeks. Already, this is a country where we've seen ECOWAS peacekeepers deployed to mitigate the threat of a military mutiny or coup, like we saw at the beginning of this year. If we see higher fuel prices or food prices in a country like Benin at a time of an election, this could certainly exacerbate a political outlook. We need to also look at some of those big importers of fuel and fertilizer, in particular, Zambia and Ethiopia, which are also heading to the polls later this year. So this comes into the context where many economically and politically marginalized communities around the global south, from Africa to Asia to Latin America, have over the past few years seen a rise in Gen Z mobilizations. In fact, these are protests which arguably started in Kenya or in Sri Lanka over the past 4 years, and have seen contagion of these Gen Z mobilizations or youth protests from South Asia to Southeast Asia to Africa and beyond. This is important because in the context of many of these potentially tight and heavily contested elections, these socioeconomic grievances will certainly be a factor to consider. And this is what we are trying to monitor closely on the Insight platform as we are monitoring these elections across the African and Asian continents. This also may be a right opportunity then to start talking about Asia. And I certainly feel that much of the impact of the Gulf War on Africa will see a different interpretation in Asian economies. Saif, what do you think about that hypothesis? How has Asia been impacted so far?
Hi, Robert. Hi, everyone. Yes, I would say the key difference here is that Asia's exposure to this crisis is more direct and strategic compared to Africa, which has major oil producers like Nigeria, Angola, Libya, Algeria. And so, yes, Asia is heavily reliant on Gulf oil and LNG flows, particularly through the Strait of Hormuz. So any disruption there feeds very quickly into energy costs, inflation, and external balances. Of course, many Asian export-oriented economies also depend on the Red Sea and Gulf routes for trade. So shipping disruptions are posing serious challenges. And you also have tens of millions of Asian workers in the Gulf who are sending back billions of dollars in remittances, which are a critical source of foreign exchange for countries like Bangladesh, Pakistan, India, and the Philippines. So yes, yes, Africa is being impacted in terms of inflation and other issues, but perhaps Asia is a bit more exposed due to its heavy reliance on Gulf oil and LNG.
these transmission pathways do seem to be different then between Africa and Asia. Fertilizers in Africa and remittances in Asia. Thank you, Saif. Let's zoom in maybe on a few of these large Asian or South Asian economies. Obviously, let's start with the biggest of them all in South Asia, India. Can you tell us, based on your latest analysis, published indeed on the Insight platform already, what have been your findings of the impact of the Gulf War on India?
Yeah, well, I mean, India is mainly exposed through higher oil prices, feeding into the import bill, inflation, and foreign exchange pressure. The rupee has weakened sharply in recent weeks, and foreign investors dumped equities worth about $12 billion since the war started. But the Reserve Bank of India has been quite proactive, and it has used about $25 billion to defend the rupee. And it has relatively comfortable, I would say quite comfortable buffers at about $700 billion or roughly 9 months of input cover. But yes, the main policy challenge right now is inflation, which may delay rate cuts and really tighten domestic financial conditions. And I think when it comes to India, it's worth bearing in mind that its growth story is still driven mainly by what happens at home. Yes, exports matter, but a decline in domestic consumption would be a lot more concerning. And we are already seeing a slowdown in certain industries due to the energy shock. But with that said, India remains more resilient than most of its neighbors. But like most countries, if it's a protracted conflict in the Gulf, then there will be various implications, including reduced remittances, which will obviously be a major concern for Indian policymakers.
Thank you, Saif. We've seen quite a bit of interest from our clients over the past month in Pakistan, because Pakistan is a country which has alliances with Saudi Arabia, close friendships with Iran. It is fighting a war already with its neighbor Afghanistan, and at the same time is a key partner for potential peace negotiations in the Gulf War. We have to therefore look at the political economic outlook of Pakistan. And again, I think we'll be publishing on Pakistan, I believe, next week. So it would be useful to get maybe a snapshot from our head of Asia forecasting of what Pakistan's position will be as we start to move into the next phase of the Gulf War.
Yeah, really interesting question. I mean, I think we all know that from an economic point of view, Pakistan is quite vulnerable, right? The country has limited foreign reserves, high levels of sovereign debt and debt servicing obligations. The import bill right now, as far as energy is concerned, it's 30 to 45% higher than what it was in January. Yes, the IMF, there was a staff level agreement with IMF. I think it was finalized a couple of days ago, but the executive board of the IMF has not yet approved it. But it's only about $1.2 billion. So the external position is quite fragile. But what Pakistan is trying to do right now is to increasingly leverage its position as a middle power of some sort in West Asia to hopefully help resolve this conflict. Obviously, it is not in Pakistan's capacity to do something like this. It can play the role of a mediator, like you said, because of its close ties with the US and Iran. And also China, and I just checked the headlines. Pakistan and China, they are jointly proposing a 5-point peace plan. But like I said, it does not have the economic or military capacity to enforce a ceasefire or anything of that nature. But that will depend on the calculations of the US, Israel, and Iran. But what Pakistan is hoping to do through its diplomatic efforts is to essentially enhance its reputation as an ally to these countries and hopefully in future when this conflict dies down, attract more investment from the US, from the Gulf, and others, and reach more defense deals with other countries. So that's its sort of main aim right now. Yeah.
You know that we have lots of European clients joining us today from at this live webinar. And maybe then also worthwhile to put things back into the context of looking into the European backyard. And at the beginning of the year, the Insight platform expanded coverage for premium Insight members to Russia and Ukraine. And there's been a lot of discussion to what extent Russia is benefiting from the war, and to what extent Ukraine is seeing a more detrimental impact, but maybe with some offsets. What are your thoughts about this, Saif?
Yeah, a really interesting question. I think the Iran conflict is definitely making the Russia-Ukraine war more difficult to resolve by adding a new layer of geopolitics and even geoeconomics. The peace process was already quite complex, and there has not been any peace talks, rather. And there has not been any real breakthrough in the talks that were held in Abu Dhabi and Geneva in recent months. And right now, both sides are essentially trying to use this Iran crisis to improve their bargaining position. So for Russia, the main advantage is economic, as higher oil prices boost state revenues and give the Kremlin more resources to sustain its war effort as the spring offensive gets underway. Russia is also a major producer of aluminium and LNG, so it's trying to fill some of the gaps left behind by Gulf countries. Ukraine, on the other hand, is trying to use this conflict to strengthen ties with Gulf partners. It signed air defense deals with a few Gulf countries like Saudi Arabia, and it is offering its anti-drone expertise to these countries. And it hopes that through these deals, in future, it can get more military, financial, and diplomatic support from these countries, as well as the US. It's not yet clear whether, there have been reports about Russian military and intelligence support to Iran. And it's not yet clear whether this will in any way prompt the Trump administration to increase pressure on Russia, because the view in Kiev is that the Trump administration has been somewhat lenient towards Russia. So yeah, let's wait and see what happens on that front.
Indeed, let's see, and let's wait and see. You're absolutely right. But I did want to ask you one more question on this, and that's the same question I asked Jack earlier. Relates to the impact on trade and development finance, and obviously Asia and Ukraine are massive beneficiaries, certainly of development finance and also trade finance in some countries. What do you think? How is Asia, maybe Ukraine, going to be impacted by these different scenarios that Bilal laid out at the beginning of the hour?
Yeah, I mean, my answer is not going to be, fundamentally different to what Bilal and Jack said earlier. So I think essentially, trade finance is going to become, tighter and more expensive due to what we are seeing across the world in terms of energy prices, shipping and freight prices, insurance costs, and things of that nature. And of course, if we are looking at vulnerable economies in Asia, whether it's Bangladesh or Pakistan, yes, trade finance will become more tight. And as far as development finance is concerned, I think we will see a bit of a shift from long-term transformation towards what I would call short-term stabilization, right? Because the Asian development, for example, said that if these disruptions persist, growth in developing Asia and the Pacific could be cut by up to 1.3% this year, with significantly higher inflation. So for development finance institutions, that means higher sovereign and credit risk in energy importing economies, potentially weaker project viability as input and energy costs rise, and more pressure on poverty reduction and broader development goals. We should also expect more demand for budget support, emergency import financing, balance of payments help. I mean, for example, Bangladesh, it doesn't have huge financial reserves. I think reserves are sitting at about $34 billion, and it is requesting the ADB and other multilaterals for more assistance, about $2 billion to deal with this fuel and LNG shock, and we might see more requests of that nature from other countries. And yes, again, this conflict is having an impact on the global economy, including the European economy, which may also have implications for European assistance to Ukraine.
Thank you very much, Saif. And I've seen a couple of more questions come in, and one of them is perhaps a really good one to end off on. And it's also one that's been burning in my mind as we are starting to anticipate some of the comments that may be made later today from the Oval Office. Looking at a potential where the US leaves the conflict, but does so unilaterally without any type of collaboration with Israel or the Gulf states. Bilal, going back to your escalation and de-escalation pathways as you laid out earlier, can you put this into the context maybe of what announcements we may or may not be hearing over the next few hours, and whether a US exit, under the circumstances of a US exit, and should Israel continue, whether there will be diverging war objectives for the two countries?
So just before this announcement, we know that President Trump has been telling reporters that the US could leave the conflict in for 2 to 3 weeks. The goalposts have been shifting over the past few days, and we know that it's within the playbook that the US can announce a unilateral withdrawal of the war, and that the objectives of the war have been met. And of course, we do have reports that a number of Iran's military capabilities has been impacted, although not necessarily completely decimated. But in a scenario, first of all, our scenario does not assume that the US and Israel act as a single actor. We've highlighted that divergence is possible. And a lot of the de-escalation scenario banks on the fact that the US is able to rein in and Israeli maximalist approach in the region and continued airstrikes against Iran. So that is part of our baseline views on de-escalation scenarios. And the current structure already reflects diverging objectives between both parties. So the US is orientated towards limiting escalation and restoring maritime stability, while Israel is still pursuing a maximalist, broader campaign against Iran and its regional network, including sustained operations in Lebanon, of course, and the possibility of annexation of a large part of southern Lebanon is becoming more and more plausible. So if the US reduces its role, the scenario shifts away from managed escalations to more of a war of longer attrition, where Israel can sustain military pressure, but it cannot, in this scenario, replicate the US's role in securing maritime routes or coordinating regional defense or even containing retaliation across several fronts and geographies. So this could create a gap in escalation control and increases the likelihood of persistent disruptions in Hormuz specifically and the Red Sea through Iranian and allied responses, Robert.
Thank you very much, Bilal. And just looking at this map in the background, we have seen quite a few changes in the country risk ratings in Africa, in Asia, and of course certainly in the Gulf as well, where a number of these risk scores have quite dramatically changed over the past few weeks, and we will continue to update these for all countries in the world, and particularly, of course, those that we monitor closely on the Insight platform. Worthwhile, as an ending note, to mention that we at Pangea-Risk, as part of your membership with Pangea-Risk, you have access to the Insight platform, but you also have discounted or preferential access to analyst engagement. So if you would like to find out more in terms of reaching out to our analysts, then please contact your account manager, or please drop us an email, and we can give you further information about how we can hold these types of presentations bespoke for your organization based on the countries and sectors that you care about, and also how you can directly discuss some of these issues, questions or concerns you may have with our analytical team. On the same side also, we have a quite important advisory business that works closely with our Insight analysis team. And again, if you have any more bespoke or tailored requests regarding the Gulf War or your particular interests, then please reach out to your account manager or through the website. Finally, it's worth mentioning that the Insight platform will continue to monitor the Gulf War. We have several publications lined up next week, and we'll be closely looking at the scenario escalation pathways as laid out in this presentation, and how all these different countries in Africa, Asia, and the Middle East will be impacted. We would like to thank you very much for all your questions and your participation in this webinar, and for all your support. Thank you very much from me and from everyone at the Pangea-Risk team, and we will look forward to working with you. Bye-bye.